If you have ever looked at the stock market and felt completely lost, numbers flashing red and green, words like PE ratio and market cap being thrown around, like everyone else already understands them, this video is for you. In the next 15 minutes, you will understand exactly what the stock market is, how people actually make money from it, and how you personally can open an account and place your very first investment. Welcome to Ponchifolio. This channel exists for one reason: to make investing understandable for everyday people without confusing textbook language. If you find this useful, consider subscribing. Now, let's begin. At its core, the stock market is simply a marketplace, a place where people buy and sell small pieces of ownership in companies. Imagine your neighbor owns a small coffee shop and wants to expand, but doesn't have enough cash. Instead of borrowing from a bank, they sell a percentage of ownership to other people in exchange for cash. Right now, if 10 people each pay $1,000 for a 10% stake, each of them now owns a small slice of that coffee shop. If the business does well, their slice becomes more valuable. That is exactly what a stock is. When you buy a share of a company like Apple or Microsoft, you are buying a tiny legal ownership stake in that actual business, its assets, its profits, and its future. Now, how do companies end up on the stock market? When a private company wants to raise money from the public, it goes through an initial public offering, or IPO. Once public, share prices move constantly based on supply and demand, driven by company profits, growth expectations, and overall market sentiment. In the short term, prices are driven by emotion. Over the long term, they tend to follow the actual growth of company profits. You've probably heard of the New York Stock Exchange and NASDAQ. The NYSE is the largest exchange in the world by value, home to many established companies across finance, energy, and healthcare. NASDAQ is known for technology. Companies Apple, Microsoft, Amazon, and Google's parent company Alphabet are all listed there. Outside the US, major exchanges include the London Stock Exchange, the Tokyo Stock Exchange, and the Shanghai Stock Exchange. Public companies are required to regularly disclose their financial performance, which is part of what makes these markets relatively safe and transparent. Now, here's the part you've been waiting for: how investors actually make money. There are two ways. The first is capital appreciation, buying a stock at one price and selling it later at a higher price. If you buy a share for $50 and sell it for $75, you've made a $25 profit. The second is dividends. Some established companies share a portion of their profits directly with shareholders, usually quarterly. If you own 100 shares of a company paying a $1 annual dividend per share, you receive $100 a year simply for holding those shares. Many long-term investors focus on dividend-paying companies and reinvest those payments to compound their returns over time. Not all companies pay dividends. Many fast-growing tech companies reinvest all profits back into the business. Instead, you'll also hear the terms bull market and bear market. A bull market is a sustained period of rising prices and high investor confidence. A bear market is a sustained decline of 20% or more, often tied to economic uncertainty. Here's the key insight: bear markets are a normal, recurring part of investing. Markets have historically always recovered and gone on to reach new highs. Investors who panic sell during downturns often lock in losses permanently, while those who stay patient are historically rewarded over the long run. Let's quickly cover the essential vocabulary. A ticker symbol identifies a stock. Apple trades as Apple Market. Capitalization is a company's total value, share price multiplied by total shares. The P or E ratio compares share price to earnings, helping judge if a stock is expensive or cheap. Dividend yield shows annual dividend as a percentage of share price. Volatility measures how much a price fluctuates. Higher volatility means higher risk. A portfolio is your full collection of investments. Diversification means spreading investments to reduce risk. And an index fund tracks a broad group of stocks, like the S&P 500's 500 largest US companies, widely recommended for beginners because of instant diversification at low cost. Now, let's move from theory into action. How to actually open an account and buy your first stock. Step 1. Choose a brokerage, an app-based platform offering commission-free trading where you can open an account in minutes. Step 2. Complete identity verification, standard legal requirement, just like opening a bank account. Step 3. Fund your account by linking your bank. Many platforms let you start with as little as $1 through fractional shares. Step 4. Research the company before buying. Understand what it does and why you believe in its long-term value rather than buying because it's trending online. Step 5. Place your order. Search the ticker symbol, enter the amount, and confirm. From there, your job as an investor is mostly patience. No conversation about investing is complete without addressing risk. All investing carries risk. There is no guaranteed return. The most effective way to manage risk is diversification. Rather than putting all your money into one company, spread it across many companies and industries. This is exactly why many financial professionals recommend beginners start with broad index funds instead of picking individual stocks. Even if some companies struggle, the fund is protected by the strength of the others. Also, only invest money you won't need in the short term. Funds needed within the next year or two should generally stay out of the stock market. Investing works best over 5, 10, or more years. Let's close with the mistakes that quietly cost new investors the most. Panic selling during downturns locks in losses that would likely have recovered. Chasing trends. Buying a stock just because it's popular online is speculation, not investing. Lack of diversification significantly increases risk. Trying to time the market perfectly rarely works, even for professionals. A steady, consistent habit outperforms waiting for the perfect moment. And the biggest mistake of all, not starting at all. Time in the market is one of the most powerful tools any investor has, and starting early, even with small amounts, matters more than most people realize. That is the complete foundation of stock market investing. What a stock represents, how the market works, how money is actually made, the vocabulary you need, and the exact steps to make your first investment. If this helped things click into place, subscribe to Ponchifolio for more breakdowns like this, and let us know in the comments which topic you'd like explained next. Thank you for watching, and we'll see you in the next one.